First of all, I'd like to thank the New England Council for inviting me here to speak with you all. And I just got to say, I'm really happy to be here, mainly because I just found out that this next hour will count towards my community service. So I got that going for me. All right, basically we have an hour to basically jam in about 3 hours worth of economics. There's a lot of interesting things happening. I know a lot of us want to figure out, hey, how is this economy going to be doing the next couple of years? We're all getting into our strategic planning time of year where maybe look out 5 years, 3 years. And of course, we have our annual budgets we have to do. As was mentioned, I'm on the board of directors of the University of Wisconsin Credit Union. We're actually in that right now trying to figure out how is this economy going to be going? More importantly, where are interest rates going to be going? Because we are basically what? Money traders, right? We buy and we sell money. We take in deposits, pay one interest rate, lend the money out at another interest rate, hopefully living off those net interest margins or those spreads. So we want to figure out where are interest rates going. As was mentioned in my bio, that I do teach economics at the University of Wisconsin in Madison. I teach the banking courses there and the macroeconomics courses. And I tell the students the first day of class, what is the most important price in any economy? It's not the price of oil. It's not the price of wheat, the price of gold. It's the price of money. It is interest rates. And basically that controls how our economy is going through expansions and recessions. So we need to basically talk about the price of money first and foremost, especially since that's our business, buying and selling money, being money traders. So basically what I want to do here is start out my presentation and basically hold a 5-minute Federal Reserve Board meeting. I do have a handout in your black bags. There's a handout in there chock full of economic charts and graphs. I kind of follow the economist credo that if you can't say it with a chart or a graph, then it's probably not worth saying. So there's a lot of charts in here. We'll try to get through most of it. But basically, I want to hold a 5-minute Federal Reserve Board meeting. Remember last week, the Federal Reserve did meet in Washington, D.C. They raised interest rates 1/4 of 1 percentage point. We're going to look at the same charts today that they looked at last week to analyze why did they raise interest rates, and more importantly, what are they going to do with interest rates for the next year or two with help with our annual plan, our strategic plan. So basically, let's hold a Federal Reserve Board meeting. All of us take our credit union hat off, put on the hat of a Federal Reserve Board member. Basically, what does the Federal Reserve care about? What's called their dual mandate. The two things the Federal Reserve cares about the most, one is stable prices. They want to keep inflation low and stable. That is their number one mandate, their number one goal. The second thing is they want full employment of resources. They don't want our labor resources in this country, say, sitting home watching television. If they're able and willing to work, let's get our entire labor force working. They also care about employment of capital. Think of factories, office space. They don't want factories sitting idle. They want all the factories running. So you got labor and capital, you bring them together, you produce what? Goods and services. Think of a credit union. You got your building, your machines, your tools, you bring in some labor, you produce financial services. That is the two goals given to them by Congress. Well, just like your credit union may have some critical measures, you may have some goals like return on asset goals, asset growth, loan growth goals. We all have those goals. The Federal Reserve has a nice little table here that they like to have as their long-run goals for the U.S. economy. And then they have a column right next to it called the actual. Are we actually hitting these goals? Well, let's take a look at what the Federal Reserve looked at last week, each one by one. First of all, inflation. They like to see inflation at their long-run goal of about 2%. Notice the actual column there. They reached 2% basically last quarter. We finally hit 2%. Just to give you what the chart looks like on this, here it is. You see that blue line? There's the U.S. inflation rate. You see that bar right there? That's the Great Recession 10 years ago. Meredith talked about it. Remember she talked about 2008? Well, it was 10 years ago this month that we saw basically Lehman Brothers fail, Fannie Mae, Freddie Mac fail, the biggest insurance company, AIG fail. That was 10 years ago. It took us a long time. Notice, see that inflation rate is kind of between 1% and 2%? We had weak inflation. We had inflation too low for too long. Now, we deal with interest rates. We deal with money, right? Why have interest rates been so low for so long? One reason, low inflation. It works like this. When you have low inflation, you have low interest rates. When inflation goes up, interest rates go up. Here's our forecast for the next few years. You see that green line right there? There's our forecast. We expect inflation to be running a little bit hot. This is like a little bit of an overheating economy. So expect higher inflation the next 2 years, which means slightly higher interest rates. Notice the gold line across my chart. The gold line represents where the Federal Reserve wants this economy to be, that 2%. It's kind of like the organic long-run trend for the U.S. economy. Our economy typically runs at about 2% inflation. It's been weak the last few years because of the weak recovery, but we're going to be running hot the next 2 years. How does that impact your credit union, you may say? Well, so what? A little bit high inflation? Well, we're going to see higher interest rates. Mortgage interest rates will be going up. Deposit rates will be going up because of a little bit higher inflation. Now, you may say, Steve, what's the causation? What is causing this higher inflation that you speak of? Well, take a look at this chart here, the value of oil. Oil prices are going up. We're seeing oil today at around, what, $73 a barrel. Just like a few years ago, it was around $34 a barrel. So oil prices are rising. We're also seeing a very tight labor market. We'll talk about that more in a minute. But we're going to see wages start to increase. And of course, when firms get higher wage costs, they do what? They raise the price of the product. You raise the price of your product all across the country, that'll lead to inflation, which I said earlier will lead to higher interest rates. So we are running a little bit hot. This is one of the world's, let me make a claim here. This is a pretty bold claim. This is the greatest world economy ever. Now, that's a pretty bold claim. You should say, hey, Steve, where's your evidence to support this claim that this is the best world global economy ever? Let me ask you, how many countries are there in the world? Does anybody know, like at the United Nations, when they meet and they all raise their hands and do votes, how many countries are there? About 195. Normally, you have about 30 countries in recession at any one time. The rest are growing, some are receding, about 30 in recession normally. Take a guess, how many countries are in recession today? 3. It is the lowest ever. Almost all the countries in the world are all expanding and growing. That, of course, it means they're buying oil, they're buying tin, copper, aluminum for their manufacturing process. Expect oil prices to keep rising to maybe $80, $90, even $100 in the next couple years, pushing up that inflation, pushing up interest rates in the United States. The Federal Reserve will raise interest rates to stop this overheating economy. Let's move on. What else does the Federal Reserve care about? Well, like I said, they care about the full employment of our labor resource. Like I said, I've been teaching macroeconomics at the University of Wisconsin for about 20 years now. Every econ textbook I've ever used said about 5% is the long-run goal. Basically, in the long run, the U.S. economy tends to that. You know, economics is taught in the social science building at UW. Think of social science, those two words. Social means human. Science means kind of applying math equations to the human animal. Let me ask you, what is your normal body temperature? What's your normal body temperature? 98.6 degrees. That's where your body tends to go to, right? Sometimes it runs a little bit hot, sometimes a little bit cold, but it kind of cycles around 98.6 degrees. Well, think of the macro economy. It's just made up of 330 million Americans. We have cycles, we have trends. Basically, here it is, the trend. We basically cycle around, roughly around 5%. Notice I got my goal line across that chart right there, around 4.7%. Economists have kind of lowered it a little bit. But notice the economy cycles around that 4.75% unemployment rate. Where are we today? Well, you see on my chart, we're actually at around 4% today. We kind of overshot on that. Basically, the labor market is extremely tight, meaning it's very difficult to find workers for, say, your credit union. I travel around the country talking to credit union executives all the time, asking them, what are your biggest concerns? Meredith mentioned it. Basically, they tell me what? Human resources. It is very difficult to find workers to staff their credit union. Basically, I have difficulty finding, 1, workers that can show up on time, 2, can pass a drug test, 3, can pass a background credit check. It is very difficult to find workers today. Now, what does the future look like? Once again, we're going to do our annual plan, our strategic plan the next couple of years. Basically, here it is. The unemployment rate is about 4% today, as you can see from this chart. Below that natural, organic body temperature, say, of 5%. We're going to hit about 3.5% next year at this time. From 4 to 3.5%. The market's going to get even tighter, meaning wage pressures are going to go even higher. Higher wages mean what for your credit union? Higher operating expenses. Higher operating expenses do what to your bottom line? Lower your net income, lower the bottom line, your profits, your earnings, whatever's left over at the end of the year. It is going to be a very tight market next year. Notice the unemployment rate is forecasted to start to rise by 2020. When the unemployment rate is rising, what is the economy doing? Typically starting to slow down, contract. So just to give you a heads up, we're actually forecasting a recession by this time in 2020. The second half of 2020, a little bit of an economic slowdown. We'll talk more about what's going to cause that. Basically, we expect the unemployment rate to go up. Now, you may stop me and say, Steve, that's great. The unemployment rate's going to go up. How does that impact your credit union? Well, take a look at this blue line I'm going to add to my chart. The blue line is what? The delinquency rate. Loan delinquency rate. Normally, when the economy is good and everything's right with the world, when your body's at 98.6 degrees, the delinquency rate should be what? You see this purple line I just added to my chart? there is the 98.6 degrees, if you will, or it's basically about 0.75. Translation, you have $100 in loans, 75 cents are going to be delinquent. You're always going to have some delinquency at your credit union. Why? Even when the economy is great, like today, if you can get a job, you know, it's not a problem getting a job today. But you always have idiosyncratic life events that cause people to be delinquent on their loans. Maybe they got hit by a bus, they got divorced, some uninsured medical expense, whatever. You're always going to have that 0.75 purple line. Notice, we're at that. Notice how we cycle, how the blue cycles around that purple. There's that seasonality of basically every March it drops down to a low level of delinquency. Everybody gets their tax refund or a bonus, and then the delinquency goes up throughout the year. Then it drops again in March because of tax refund bonuses, and then it goes up. Notice how we cycle around that, just like we cycled around that back in 02, 03, 04. So basically the economy is back to normal. Just like your body is back to normal at 98.6 degrees. We're forecasting this blue line, the delinquency rate, to start heading up by 2020 because of the higher unemployment rate. Notice the close correlation between the blue and the unemployment rate. Economists love charts like this. We have this tight positive correlation between the two, and we expect it to slowly go up. Now, it's not going to go up like it did here back in 2010, 2011, when the delinquency rate hit about 1.8%, meaning you got $100 in loans, $1.80 was delinquent. It's going to be a lot lower this time. This is going to be a modest, mild recession, and I'll tell you why in a minute. But let's move on. The economic output gap. One of my favorite charts to show my macroeconomics students at UW is this one right here. It's called the economic output gap. Notice the word gap. The Federal Reserve wants a zero gap. Just like a carpenter doesn't want to have gaps in their work, the Federal Reserve doesn't want to have this gap in the economy. And I'll explain what that gap means in a minute. But notice we actually have a positive 1% gap in our economy. In other words, our economy is overheating. It's running a little bit hot. Here's a chart that I love to show my macro students on the first day of class to say, hey, this is the U.S. business cycle. And where are we in the U.S. business cycle? GDP output gap, you see the title there. Basically, this kind of shows you the recessions, the expansions. Let me ask you, I'm from Wisconsin. I live in Madison, Wisconsin. What is Wisconsin known for making? Cheese. Now, everybody says cheese. I don't want to talk about cheese. What's the second thing we're known for making? Beer. It's really weird. Everybody says beer is number 2. But I don't want to talk about beer either. What's the third thing we're known for making? There. Harley-Davidson motorcycles. They got a big factory there in Milwaukee. That's where their headquarters is. We make Harley-Davidson motorcycles. I kind of want to get in your mind, this mental exercise, kind of an old-fashioned factory with an assembly line, motorcycles rolling off the assembly line where people are putting on the tires and the seats and the gas tank and the handlebars and all that stuff. Let's say when they designed that Harley-Davidson motorcycle in Milwaukee, they brought in the engineers and the architects, and they sat down and said, let's make a factory that can produce 100 motorcycles per day. 100 motorcycles going to flow out of here every day. Okay, easy number to remember. Let's say you went back in 1995, you called up the manager at Harley-Davidson and say, hey, how's your output going? You got any gaps? Are you running too hot, too cold? And they said, well, you know, right now in 1995, we're running about a minus 2% output gap. Minus 2% off of 100. So how many motorcycles are they making? 98, right? They're only making 98 motorcycles. Assembly lines are not running at real full speed ahead, kind of laid off maybe a couple workers. Notice by the year 2000, you call them up, it's about what? 3% positive gap. How many motorcycles are they making back in 2000? 103 cycles. Now you should stop me and say, wait a minute, Steve, you said Harley was designed to make 100 motorcycles a day. How can you make 103 a day? What do they do at Harley to make 103 cycles a day? Stay late. Yeah, overtime, right? Pay people overtime, have them come in a second shift, a night shift. But what do you pay people when you pay them overtime? Time and a half. Wages start to go up very quickly at Harley. What is Harley going to do to the price of the motorcycle? Raise the price of the motorcycle. If everybody's raising their prices, what's that called? Inflation. Remember, we're holding our little Federal Reserve board meeting here. The Federal Reserve doesn't like inflation. They want to keep it at 2%. What is the Fed going to do with interest rates to slow down people buying motorcycles? You raise them. Notice, watch the chart. See that blue line I just added? There's the Federal Reserve. There's you guys right now. There's the Federal Reserve raising interest rates in the year 2000. So banks will raise interest rates, credit unions will raise interest rates to slow down demand. People walk into the bank or the credit union and say, oh, your motorcycle rates have gone up. Well, I guess I'm not going to buy a motorcycle now. So they use that price of money to control the economy. They raise interest rates when things are too hot. There's an overheating economy. There's an overheating economy. If we're in a recession, see the purple bars? Those purple bars on my charts always represent recessions. Basically, if we're in a recession, the Fed does what? They lower interest rates dramatically. The economy overheats, they raise interest rates. The economy's in the Great Recession. Notice that depth here. If you would have called up Harley-Davidson or your typical factory in the United States and say, hey, what's your output gap? They say, we're about a minus 6% at Harley. How many motorcycles were they making? 94. Look how deep this hole was, this recession, compared to this recession, compared to this recession. Why do we call it the Great Recession of 08, 09? Look at the depth of that hole. The second thing, look at the duration. How long was Harley not operating at full speed ahead? It took us till this time last year. Notice, 2017, basically the summer. It took us to the summer of last year to get Harley back to producing 100 motorcycles. That is a very long time to be in an economic hole. Where are we today? Well, as I said here, we have a positive gap of 1%. There it is right there, 1%. So basically, Harley's now producing 101 motorcycles. Once again, Harley's just a representative of the typical factory. The average factory in this factory is running hot right now. They're running full speed ahead, a lot of orders coming in. It's hard to maintain it. They basically kind of have to postpone maintenance, hire extra workers, maybe go overtime. We're running at a hot economy. I want you to play the economist. You see, these bars are recessions. We want to forecast when the next recession is. Where is the economy before every recession? Where is the economy before? It's running hot. Economies always run a little bit hot. The Federal Reserve raises interest rates, choke off demand, and it typically triggers a slowdown, but maybe too much of a slowdown, leading to a recession. So we are back to running an overheating economy. That's why the Federal Reserve is doing this. Notice that blue line. That's that Fed funds interest rate we always hear about in the news. What's the Fed funds interest rate? The interest rate that banks lend money to each other overnight. Fed funds interest rate. Bank A lends money to Bank B overnight. It is raising it. We expect the Federal Reserve to raise, like I said, they raised interest rates last week. We expect them to raise it again in December. Why? Because the economy is going to continue to overheat. This is going to continue to rise higher and higher as the year progresses. The Federal Reserve is going to have to raise rates. And you say, well, Steve, how fast? Basically, they're going to keep raising rates 1/4 of a percentage point each quarter. It's kind of easy to remember. A quarter. Raise interest rates 1/4 every quarter for basically the next year. We'll have rates by this time next year will be 1 percentage point higher than they are today, because the Fed's looking at this chart and say, we are in an overheating economy. We have to dampen down demand somewhat. All right, moving on. What else they care about? Well, there it is. The Fed funds interest rate. They want to get to about 3%. Remember I used that analogy of the natural body temperature, 98.6 degrees? Well, interest rates for the U.S. economy for the short-term rates should be about 3%. Like I said, the Federal Reserve just raised this to between 2 and 2 1/4, so this is a little outdated number here. But basically around 2%, we're heading to 3. The Fed wants to get 3%. That's the natural body temperature, 3%. So expect this 2% to hit 3% over the next year as the Fed raises interest rates 1/4 of a percentage point every quarter for the next year. That's where short-term rates are going. Once again, you should ask me, Steve, how does that impact my credit union? Bring it back to my credit union. Well, basically it's this. Your money market rates, your deposit rates, your CD rates are basically priced off this Fed funds rate. So as the Fed funds rate goes up, your cost of funds, money market rates, CD rates, will also be heading up. We are basically what's called normalizing interest rates. You hear that phrase like in the Wall Street Journal, New York Times, the normalization of interest rates. Well, this is a normal interest rate, 3%. We have abnormally low right now because what the Federal Reserve is doing with their monetary policy. They got interest rates a little bit below normal to kind of goose this economy, but they say, you know what, the economy doesn't really need goosing anymore. It's already operating above potential. We need to raise interest rates. The last thing the Federal Reserve cares about is this right here, the Treasury rate. Now, if you've ever been to Washington, D.C., they have these two big buildings, right? You've got the Federal Reserve building, beautiful marble building over here. Then you got the Treasury Department over here. Let me ask you, who's the Secretary of the Treasury? Who's the Secretary of the Treasury today? Steve Mnuchin. It was just on TV. I was watching. They revamped the NAFTA bill. He was standing behind President Trump. Basically, the Secretary of the Treasury, Steve Mnuchin, he can borrow money today at roughly 3% for a 10-year Treasury bond. Does anybody know, what is our deficit going to be this year? What's our deficit this year? Government spending is up here. Tax revenues are down here. What's our deficit? Over $1 trillion. One of the reasons why this economy is doing so well is because we're basically financing it by borrowing from our children. But we have $1 trillion borrowing we have to do. $1 trillion. Steve Mnuchin can issue a 10-year treasury bond to, say, an insurance company or a pension fund and only pay 3%. Where should it be? According to the economic forces, that 98.6 degree body temperature analogy I keep using, we should be about 4% right now. So that 3 will be heading up to 4 over the next year or so. But that begs the question, why are interest rates lower than what they should be? Can anybody answer me that? Why are long-term treasury rates so low today compared to what they should be at 4%? It's basically the idea what happens in Europe doesn't stay in Europe. The European Central Bank, which is led by Mario Draghi, he's still printing up a lot of money there. Where are interest rates in Europe compared to the United States? They're extremely low. They got very low interest rates. In fact, they have a lot of negative interest rates. So if you're Hans over in Germany and you've got 600 million euros, do you invest in European bonds? No, you bring your money to the United States and buy American bonds. But if you're bringing all this money to the United States, you're increasing the supply of money to the United States. You increase the supply of anything, what happens to its price? It pushes the price down. You increase the supply of oil in the world, price of oil falls. You increase the supply of money in the United States, the price of money falls. So this right here, this 3%, I call it the Hans effect. Hans is bringing his money here, keeping our interest rates below where they should be. We believe the European Central Bank will stop printing money relatively soon. That means interest rates in Europe will start to rise, which means Hans won't have to keep bringing his money over here, which means this 3% will head up to 4%. Here's the chart. Like I said, the most important price in any economy is the price of money, so this must be the most important chart for any economic presentation. This is interest rates. Here's that Fed funds rate we just talked about. The Fed wants to get up to 3%, so your cost of funds will be heading up. The red line is the 10-year Treasury bond. It's about 3% today. We expect it to hit 4% over the next year and a half or so. So both short-term and long-term rates are going up. Once again, you stop me, you say, Steve, the 10-year Treasury. Our credit union doesn't buy 10-year Treasury bonds. There's no way we could buy a 10-year Treasury bond. Why do we care about it? Why do you care about the 10-year Treasury at your credit union? Yeah, your mortgage rate. Your 30-year mortgage rate is basically tied to the 10-year Treasury. Basically, the rule of thumb is this. Take the 10-year Treasury rate, which is about 3%, add about 1.6 to it. What's 3 plus 1.6? 4.6. That's basically your mortgage interest rate. When a member comes into your credit union, you basically say, hey, 4.6% for a mortgage today. As this goes up to 4% over the next year and a half, where will mortgage rates be about a year and a half from now? What's 4 plus 1.6? 5.6. So mortgage rates are going up. What will that do to the housing market if mortgage rates and the 10-year Treasury kind of follow this path? It's going to depress housing demand, right? Interest rates go up, people buy fewer homes. So it should slow down a little bit of housing demand as the rates go up. Now, notice how I've got these nice smooth lines as our economic forecast for the next few years. Clearly, interest rates won't follow that. They're pretty jagged. They move up and down due to the basic supply and demand of the bond market. But basically, that's our best guess. Now, I just want to kind of throw out the caveat that there's only two types of economists in the world. There are those who can't forecast interest rates, and there's those who can forecast interest rates. It's basically very difficult to forecast interest rates. It's basically the bottom line. So we expect to move something up this path over the next couple years. The basic is we are normalizing rates in this country. Let's move on. Let me skip over this real quick and get to this right here. You know, if you had to ask economists, what's the one chart that keeps us up at night? It's this one right here. This is our deficit. Notice in 2019, next year, we're forecasting a $1.1 trillion deficit. You can see as far as the eye can see, going out to 2027, about $1.4 trillion deficit. Well, basic economics is you increase the demand for money, the price of money is going up. Well, Steve Mnuchin and whoever the Secretary of the Treasury will be in 2027, they're going to be borrowing a lot of money. Let me ask you, like I said, this is a pretty nice economy. Unemployment rate is low, inflation is picking up. Should we be running massive deficits like this? No. When you have a strong economy like this, what should we be running? See this over here on the left? These are called surpluses, meaning the government is taxing this much, but only spending this much, kind of running a little bit of reserve, building up a little reserve. We ran that back in the late 1990s. Now we're running deficits when the economy is also doing well, similar to the late 1990s. So it's a little worrisome that we're basically have these huge tax cuts from last fall. Remember, we got all those nice tax cuts in February. We saw a little bit of disposable income increase as the government took out less out of our taxes. But basically, we had massive government spending increase and massive tax cuts, leading to huge deficits, which is going to push interest rates up, push up mortgage rates, and slow down housing. One factor that could slow down housing. Let's move on. Basically, so people say, Steve, you got these recessions planned. What causes recessions? Well, basically, the necessary condition for a recession is one, an overheating economy. We just talked about that. Here's an overheating economy followed by a recession. Overheating followed by recession. We're overheating, so we expect a recession maybe in about 2 years from now. All right, so you need an overheating economy. Why does that typically happen? Well, you get a tight labor market. Well, that sounds familiar. We have a very tight labor market today. Unemployment heading down to 3.5. Will lead to increased wages and prices. If prices go up, Fed raises interest rates. But basically, there are 4 things that cause recession. So let's just kind of go through the list, try to figure out which of these 4 will cause the next recession. Causation number 1, a financial imbalance or excess, leading to a bursting asset bubble. Let me ask you, what caused the Great Recession back here in 08-09? What asset bubble popped? Housing. Yeah, housing prices fell about 35% between 2006 and 2010. Housing prices came down. You and I experienced what's called a negative wealth effect. Our wealth dropped significantly. We started saving more, but by definition, if you're saving more, you're spending less. That causes a recession. That was the 2008 housing market, even the 2001 stock market crash. Remember in 2001, our 401ks were flush, record highs. We thought we were all financial geniuses. And then what happened by 2002? Our 401ks turned into what? 201ks. Basically, they got dropped by half. We started saving more once again, spending less, causing a recession. Do we think there's any big asset bubbles out there today? You know, we got housing prices are actually kind of back to the long run average. If you look at price of homes relative to incomes, the price of home relative to rent, kind of a price income ratio, they're kind of back to the long run average. Stock prices look a little bit bubbly. We'll talk more about that in a minute. But basically, most economists don't think we have a big asset bubble that's going to pop. So let's scratch this off our list saying this is probably not going to cause the next recession. Number 2, some external shock. What do I mean by this? What's an external shock that could cause a recession? Yeah, very good. A terrorist attack, a war, a trade war, maybe with China, tit for tat, tariffs put on them. So we're kind of concerned about a trade war. We just had what? Just a couple weeks ago, another 10% tariffs put on $200 billion of Chinese goods. So we are concerned about a full-blown trade war, but hopefully cooler heads will prevail because nobody really wins in a trade war. But there are things out there that, of course, could lead to a recession. Number 3 here, high inflation. If inflation gets too high, and if you guys are the Federal Reserve, you're playing the Fed, inflation gets too high, you raise interest rates to slow this economy. It's very difficult to know how high to raise interest rates and how fast to raise interest rates, which typically can lead to a recession. So say, if inflation gets too high, we're going to have some monetary policy tightening. Translation, we just raise rates. High inflation. Notice in my forecast, I had inflation running a little bit above 2%, not much, but could we get to maybe a period of 4 or 5% inflation in this economy? Some economists out there, if you watch like CNBC in the morning, they'll every once in a while bring on economists and say, no, we're going to have 5, 6, 7% inflation soon. Why do they keep saying that? Why high inflation? What has the Federal Reserve been doing with our money supply in the last 10 years? They've been printing up a lot of money. Printing up tons of money. Print up the money basically to do what with all this money? To buy bonds from banks. So they print up this money, call it Bank of America, Citibank, the big New York City banks, and say, hey, you got a bunch of bonds on your investment portfolio, we'd like to buy them from you and give you cash. Hopefully they'll let the banks lend that money out to you and me, but basically the banks are flush with cash, about $2 trillion in cash. Well, if they lent all that $2 trillion out right away so we could all buy cars and appliances and everything else, that could lead to inflation. But we haven't seen this high inflation yet. It's been about 10 years since the Federal Reserve has been printing up all this money. So all this talk of high inflation kind of reminds me of the talk of Bigfoot. It's often discussed but never seen. We never see this high inflation, just like we never see Bigfoot. So I would cross this one off the list. That's not going to be the cause of the next recession. That leaves only one thing left. What else causes a recession? High inventories. Let's go back to my Harley-Davidson example. Harley-Davidson ramps up the production. They start making 102, 103 motorcycles per day. But after a while, demand will drop off. Demand drops off. All of a sudden, they got too much inventory. They got too many brand new motorcycles sitting on the showroom floor, wrapped in that nice plastic. They smell nice. They're going to have to start slowing down production. We're going to have a little bit of an inventory correction probably by 2020 as the economy starts to slow down and demand starts to ebb a little bit. So more than likely, number 4 will be the purple bar that will come up by 2020. All right, well, let's see. Moving on, what's our forecast then for the next 2 or 3 years? Well, here it is. U.S. economic growth. How is the economy going to be doing? Well, right now it's doing great. In 2018, we're going to grow at about a 3% pace. Now, what does that mean? We're going to produce 3% more goods and services this year than we did last year. So say 3% more motorcycles will be produced this year, 3% more bushels of wheat, 3% more financial services will be produced, whatever. 3%, I say that's good. Once again, how can I say it's good? Well, like I said, every economist should have a gold bar on their charts. That's the natural, organic, kind of the long-run average. We should grow about 2% every year. The economy just naturally produces 2% more goods and services because we got more people in the factories and we have more productivity. Productivity plus more people gives us about a 2% target there. Notice 3% is the biggest bar in the recovery. Here's your Great Recession of 2008, 2009. Notice how many years have we gone with no recession? Well, let's count them. There's 1 year, 2 year, 3 year, 4 year, 5, 6, 7, 8. We're in the 9th year of an economic expansion and recovery since the last recession. Is that long? Yeah, that's the second longest ever. And we got data going back to 1854. We've never had, there's only been one other time where we've seen this many positive bars between recessions. We're forecasting next year running hot again, 2.3% economic growth, leading to that higher inflation as I talked about. So it's going to be a good economy next year. But then there it is, the recession. 1% growth. Think of Harley producing 1% fewer motorcycles, if you will. So a little bit of a recession there. There's our forecast. Now, I got people coming up to me all the time saying, hey, Mr. Economist, how good are your economic forecasts? Do you even know what the heck you're doing? And I usually respond by saying, come on, Mom, quit asking me that. But basically, there's my forecast. Basically, there will be a recession sometime, and we've gone a very long time between recessions. Let's move on. Return on equity. One of my favorite ratios to actually analyze how well credit unions are doing are return on equity. Think of equity as your capital, your buffer, your cushion for that rainy day. This is your net income divided by capital. That's your return on equity, right? Notice the last few years, we've been growing at about 7.2% return on equity. That's the growth rate of your equity. That's how fast your capital is growing. Your capital grew by 7.2% last year if you're the average credit union. Notice the level we're at today compared to where we were about 10 years ago. We were growing about 10% roughly, 9.9 say, back then. Think of it this way. If your capital is growing 7.5%, that means your assets can grow 7.5%. And keep that capital to asset ratio constant. So basically, this return on equity is your speed limit. Your credit union can only grow in the long run as fast as your ROE. So if your ROE went from growing roughly 10% down to 7.5%, our asset growth has to have slowed down. Otherwise, that capital to asset ratio would be falling. And right now, credit unions are trying to build their capital asset ratio. So we've kind of had this new period, it's kind of this new normal of slower return on equity, which means slower asset growth, which means a slower speed limit for credit unions. A little bit worrisome. Hopefully this will start to accelerate in the future. But once again, you can say, well, Steve, my credit union wasn't at 7.2%. Once again, these are averages. And as we know from a statistical point of view, averages mask or hide huge disparity amongst credit unions. Take a look at this chart. Here is a chart looking out by credit union, once again, return on equity, kind of the asset growth speed limit, if you will, by asset size. These are billion-dollar credit unions, so $2 billion, $3 billion, $10 billion. Their return on equity is about 8-9%. Smaller credit unions, less than 20 million assets, have a return on equity about 1.4%. So in other words, these credit unions can only have their assets grow roughly about 1% a year without reducing their capital to asset ratio. And you can see how it monotonically increases as you get larger and larger. Kind of, like I said in my banking class, we're always talking about economies of scale, that size matters, and efficiency. All those things come about. Well, one chart that shows this is right here, the return on equity. How fast your capital can grow year by year, which determines how fast your assets can grow over the long run. Huge disparity amongst credit unions. And you can see it fell a little bit here over the last couple of years, but it's staying around that same 8%, 5%, and 1% by different asset sizes. Moving on, let's see, let's go over, we talked about that already. Let's go to this. What are the big areas that we lend? Where's the lending going to be? Of course, we are credit unions. It's right in the name, credit. What kind of loans are we going to be making, and where's the headwinds and tailwinds? Auto lending is a big area, of course, for credit unions. New auto loans. This chart here shows U.S. vehicle sales. How many cars we've been selling the last few years? Notice my chart here, 18 million cars. Once again, you should ask me, Steve, where's your gold line? What is the 98.6 degree natural body temperature? Where does the economy want to be? Well, here it is. We call it the inherent demand. There's my goal line across the chart, about 16.5 million cars. That's what we normally would be selling based on, say, population growth. Think of all those college kids, high school kids coming out wanting to buy. 16.5 million. How have we been doing the last couple of years? Notice what? 18 million car sales. Very strong. We've had a nice tailwind at credit unions. Just that we're selling so many cars, thinking the pie was getting bigger. We can get a bigger piece of that pie. We had nice loan growth with new auto loans. Why was it so strong the last few years? Why has auto lending been booming at credit unions? And auto sales have been booming.
Pent-up demand.
Yeah, look at that pent-up demand. We weren't, for how many years we were selling, what, 8, 9, 10, 12 million cars? Here's the Great Recession again, the red bar. Look how it dropped off, a lot of pent-up demand. People didn't buy cars for a while, so they held off buying that car. Now they bought it in the last few years. What's the forecast? See the green line on that? The green line looks like it's slowing down a little bit. It's kind of a good news, bad news chart. The good news is we're basically above the gold line for the next couple of years, so it's going to be a strong market. The bad news is car sales will slowly start to fall. So think of the pie is shrinking a little bit. The big question for you is how do we maintain loan growth when the pie is shrinking? Hopefully we can maintain our piece of the pie, our percent of the total pie, but it's going to be harder. We got a little bit of a headwind here. Basically, a lot of people have satisfied their demand for the cars in the last few years, so it will slow down. Once again, if we're selling and producing fewer cars in this country, what's that called? If production of cars starts to slow, think of the auto industry, it would be slightly like in a recession, right? They're slowing down production. They're laying some people off, not expanding as fast. So we expect a little bit of a slowdown. The big question for us, how do we maintain auto lending? We have a lot of tools to work with, right? We've got loan rates. We can maybe lower our rate or not raise it as fast as the competitors. 2, we can loosen underwriting standards. But if we have a recession coming up in 2020, do we really want to loosen underwriting standards today when someone might lose their job in 2 years? We can open more branches. We can do more marketing efforts. We have a lot of tools to play with to keep our piece of the pie, even though the pie is shrinking. That's auto lending. The other big area, of course, is mortgage lending, the housing market, home sales. What I have here is the existing home sales. So I got a chart looking at how many homes we sell. Once again, look at my chart. Where's the 98.6 degree natural body temperature? Well, right around 5 million. These are in thousands, so this is 5 million here. Notice my goal line across the chart. 5 million is what we should be selling in a normal, healthy housing market. Take a look at this. Let's go back 10, 12 years. Back in 04, 05, 06. Look at how many homes we were selling. 7 million. This is where we should be at 5 million. We were selling 7 million. That would be analogous to saying the body temperature was about what, 140 degrees? It was going nuts. As economists, we were looking at these charts going, this is just crazy. People are just buying too many homes. Why were people buying 7 million homes when normally we should be doing 5 million? What was going on? We had rising prices. Prices rising 10, 11%. People said, you know what? I'm going to use a little speculative demand here. I'm going to start buying homes on speculation, thinking the price is just going to rise, so I'm going to buy. You all saw that movie, The Big Short. Remember those people buying 3 or 4 homes in Miami, Phoenix, San Diego, places like that? They were just buying on speculation. It was too much demand. We had too loose of underwriting standards at some banks and lenders, too low of interest rates, just forced a huge amount of money into housing. We're creating something like that. Well, when you see a body temperature that high, you know there's going to be a crash. So we went from the boom, followed by the kaboom, and then we slowly came back to that 5 million, and now we're kind of a little bit above that, not too bad. Economists aren't worried about being above the 5 million line here at this pace. So it's running a little bit hot, not too bad, the economy's strong. What's the forecast for the next 3 years? You can see the blue line right there, bang, 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 actually slight acceleration. Now you should stop me and say, wait a minute, Steve, you said something about interest rates rising over the next couple of years. Because Hans, over in Europe, won't be bringing his money here because the European Central Bank will stop printing it, so Hans will keep his money there, our interest rates will go up here, mortgage rates will go up, which will depress housing demand. But my chart says housing demand will go up. There must be some other factor pushing this. What other factor is happening right now that could increase housing demand? 2, we've got a very strong job market. Last month we created about how many jobs in this country? Anybody see how many jobs we created in August? 201,000 jobs. That's 201,000 people who now can probably go into your credit union or bank and say, hey, I'd like to apply for a mortgage because now I got a source of income. Maybe I can get start paying my mortgage payment. So basically, we call that the income effect. You get a job, you get an income. We believe the income effect will offset the higher interest rate effect. Plus, we have this demographic phenomenon called the millennials. Meredith talked about that. A lot of these millennials and Generation Xers have been kind of sitting at home, sitting in the basement after the Great Recession. Well, guess what? They're moving out of the basement. We have what's called an increase in household formation. These kids are moving out of the basement, putting down their Fortnite, not playing those video games, and they're starting to get a job, starting to actually get out in the workplace. So because of the demographic effect of millennials and Generation Xers, we expect a slight increase, acceleration in housing. So what does that mean for us? That means the pie, the mortgage pie, is going to get bigger, which means a nice tailwind for us. Let me just kind of throw out a stat. You know, back in 2004, 2005, can anybody tell me what percent of the mortgage origination market did credit unions have? Of all the mortgages being originated, what percent did credit unions originate? Was it like 20%? 50%? It was 2%. We had 2% of the mortgage origination business back here in 05, 06. Go forward 10 years in time. Where are we today? 8.6. We went from 2 to 8.6, almost 9. Say we went from 2 to 9. That is a huge increase in market share. Why? Banks stepped out of the mortgage business because they got hurt. A lot of them got hurt. We lost about 500 banks in this country. They just kind of stepped out. We stepped into that void. So we're actually doing quite well in this market. But the market, with good news is the market's going to be getting bigger over the next couple of years. All right, moving on here. How's the stock market doing? I heard somebody say, hey, is there a bubble out there? I heard somebody said stock market. Well, look at this, stock prices. This is the S&P 500 stock index. Are stock prices high today? Well, look at the chart. Stock prices go up, you get a recession, stock prices go down. Stock prices go up, you get a recession, stock prices go down. Stock prices go up and up and up. Are stock prices overvalued? I'll use that word, overvalued. What do you think? Can I answer that question by looking at this chart? Are they overvalued? No, I can't. One, I'm comparing an apple to an orange. I can't compare today's stock price versus then. Why? Because of inflation. We get about inflation about 2% a year, so think that Harley Davidson motorcycle goes up 2% a year. So stock prices will also just naturally, organically grow over time. So I can't compare today's S&P 500 versus here. You know, here's a big 2000 tech boom. You really can't compare until I adjust for inflation. So let's do that. Let's calculate the real or inflation-adjusted stock prices. See that green line I just added? That is the real S&P index, adjusted for inflation. So now I can compare an apple to an apple to an apple. Ah, look at stock prices were pretty high back then. They dropped. And then when were stock prices the highest? Today or say back in 2001? Well, today. The green line is the highest today than it's ever been. So in real terms, stock prices are the highest they've ever been. Let me ask you, are stock prices overvalued? Does the green line answer that question? Are they overvalued? No, the green line will not answer that question. The line I need to answer that question is this. See that blue line I just added? That is the price-earnings ratio. You always hear about PE ratios, price-earnings ratios. Basically, it says today we're at what, $32.50. Translation into English, we pay $32.50 to have a claim on $1 of a company's earnings. That's the ratio, 32 to 1, price-earnings ratio. Is that high? Well, notice, it's the highest we've been. You got to pretty much go back to the 2001 tech bubble to see prices that high. Remember, I keep using that analogy, 98.6 degree body temperature. Your body wants to naturally go back there. The economy wants to go back to its trends. Does anybody know what is the long-run PE ratio for the S&P 500? Long-run price-earnings ratio for stocks in this country. About 16, 17. We're at 32 today. Stock prices look a little bit high. But there's always a caveat in there. I always going to say, well, what could explain why they're so high? Have anybody heard of the FANG stocks? FANG, F-A-N-G. What does FANG stand for? Those 4 big tech companies. Who am I talking about? Who's the F in FANG? Facebook. Who's the A? Amazon. Meredith talked about that. Who's the N? Netflix. Who's the G? Google. Basically, those 4 companies explain a lot of this 32 portfolio. You factor that out, and the average stock price comes down. It's still above that 16, 18, but it comes down significantly. So basically, we kind of have our own little tech bubble, once again, of these 4 companies pushing up stock prices. But the point is, they still overvalued. But the most important point, even if stock prices did slightly come down, it would not be enough to trigger a recession. Notice here, what were prices back in 2000, the tech bubble then? We were paying $45 roughly to have a claim on $1 of a company's earnings. It's at 32 today, so it's not like the bubble. This was a bubble. We're a lot lower than we were back then. But it's still a little bit frothy, a little bit high. But like I said, I'm not concerned about this causing the next recession. Which brings me to one of my favorite quotes when dealing with stock prices. This is an economist named Hyman Minsky. All right, great economist, 20th century. He said, stability leads to instability. Nice, short little quote. But he says, the more stable things become, look at this. We've had the longest bull market in U.S. history. Bull market meaning stock price just basically keep rising and rising and rising. Look at that. Basically, stock price have moved up basically in one direction. He goes on to say, and the longer things are stable, like I said, this is the longest bull market in American history, the more unstable they will be when the crisis eventually hits. If the crisis hits in 2020, you can see the pattern here. Stocks up, recession, stock prices fall. Stocks up, recession, stock prices fall. Stock prices will probably continue to rise, but at a slower pace till 2020. If we go into recession, we will have stock prices correct like they always do in a recession. Once again, I'm not trying to forecast stock picking and timing and things like that, but history shows when you're in a recession, stock prices do come down. Because the stock price is just the present value of the future profits of the company. And if we're in a recession, profits will be expected to fall. But there's the market. Basically, we have this. What's nice for today is you and I are all experiencing what's called the wealth effect. Our stock prices are at record levels. We all feel a little wealthier. Our 401ks are flush. We go out and spend a little bit more. Maybe buy that Harley-Davidson motorcycle or a new car or a new deck put on the house. Moving on here, how about home prices? For those of us lucky enough to be owning homes in today's market, home prices are rising 6% roughly right now. What's going to happen in the next few years? We're forecasting home prices to keep rising about 5% for the next 2-3 years. So home prices are rising nice, say 6%. But let me ask you, what is the average income rising? For the average American, what is the average raise, if you will? What's the average income increase? About 3%. Okay, think of that for a second. Homes are going up 6%, but my income's only going up 3%. Is that sustainable in the long run? Can an asset go up faster than your income forever? No, because soon nobody will be able to afford a home. So clearly that's unstable. In the long run, those two have to equalize. Growth rate of homes have to equalize to the growth rate of income in the long run. So we got 6 to 3 here. Think of that, 6% home prices up, 3% income up. 6 to 3. What was it 10 years ago? Back here in 04, 05, 06, home prices rising, say about 10%. What were incomes rising back then? 5%. So still double. 10 versus 5. Incomes going up 5, asset price going up 10. Double. So people ask me, Steve, do we have another asset bubble today in housing where it's just kind of at a lower level? Instead of 10 home price appreciation and 5 income, we've got 6 versus 3. But it's still double. Is today just a replay of what happened 10, 12 years ago? I'm going to use the 4 most dangerous words an economist can say. This time is different. Today is not like it was back then. What caused this? Home price appreciation. It was a demand side effect. Too many people buying 3 or 4 homes on speculation. Demand side. Economic history has shown demand side effects can be there one day and gone the next. Look at that huge drop. Notice here's minus 10% home price appreciation. Homes falling 10%. This kind of reminds me of Warren Buffett's famous quote. He said that when the tide goes out, you can see who is swimming naked. Well, basically, here's the tide of home prices going out. 8 million Americans were foreclosed on their house. 8 million. because of the falling tide of home prices. Now we're back up to here. This I said was caused by too much demand. And history has shown demand can be very fickle. You can have the demand there today, everybody buying a home, and then gone the next. This is a different animal. This is what? If it's not demand, it's what? Supply. This is a supply side effect. If you talk to any realtor today, a real estate realtor, what is their biggest complaint? There's no inventory. There's no homes for sale. People aren't selling their homes. This is a supply side effect why prices are rising. History has also shown us that supply side effects can last a long time. We don't have enough homes for sale on the market when you have these millennials and Generation X's getting jobs and better paying jobs. So the demand is there, but the supply is not. So expect home prices to continue to rise, creating what? A wealth effect. Their home is going up 6%, they're getting wealthier, they feel good, they save a little bit less and spend a little bit more. Moving on, just to kind of show you the savings rate, once again, what is a good predictor of recessions? Is people's savings patterns, how they save and spend. Notice this chart, this is the national savings rate. It's a ratio. Think of all of your savings. Let's all do this mental exercise. How much are you setting aside for savings every month? Maybe putting a couple $100s in your 401k, maybe a few $100s in your CDs at your credit union. Think of that as the numerator, maybe a couple $1,000s, a couple $100, divided by your income, disposable income. Your DPI there, your disposable personal income. What do you get basically? What's your paycheck? Notice back here in 1995 it was around 6%. For every $100 in income, people save $6. Notice it drops dramatically here by 2000. It drops to about $4 out of every $100 being saved. Notice what happens about a year later. A recession. Why? Nobody's saving, everybody's spending. What if you're spending? That means you're buying cars, appliances, furniture. If you buy cars, appliances, furniture today, what do you buy tomorrow? Nothing, because you've already bought your stuff that you need. So that's why we get these recessions. Notice by 2003-04, savings comes back a little bit. People try to rebuild that nest egg, pay down some debt. We're a little bit high, and then it drops again. People buy a lot of stuff because they're not saving. That means they're spending. Boom, we hit another recession. Savings rate comes back up. People rebuild their nest egg a little bit, goes up, and then boom, this is where we're at today. Look at that huge drop in the savings rate. We're back down to that 3%. What do we expect coming up the next couple years if everybody's buying their motorcycle and car and appliances today? Well, we expect a recession by 2020 because everybody's spending today. It's the natural cycle of the spending saving in the U.S. economy. Why are people spending so much? That begs the question. Why is savings rate so low, spending so high? Take a look at this chart, consumer confidence. Economists actually go out and survey Americans and say, hey, how do you feel about your personal job? How do you feel about your financial situation? Look how high it is today. It's as high as it is today as it was back in December 2000. Before the stock market crash of 2001. Before September 11th, 2001. People are feeling really good today. If your member comes into your credit union and applies for a loan, and you ask them, why are you guys feeling so good? Why are you taking out all these loans? They'll come back and say, well, we feel pretty optimistic. One, sustained low gas prices. We like that gas prices are still relatively low, that when I drive away from the gas pump, I still got money in my wallet. They like low gas prices. Two, low interest rates. They love walking into your credit union, getting what, a 3% car loan, a 4.6% mortgage. They like that. Number three, low retail inflation. You go to Sears and JCPenney today and buy clothes, it's cheaper today than it was last year. Car prices haven't really budged at all. So we always talk about in economics, the production of goods and services. That's our gross domestic product, right? Goods and services. When it comes to goods, those prices are actually falling. It's the service part of our economy that's going up. Think of medical care services, maybe financial services. Those costs are rising where goods prices are actually falling. So we average it all up. That's how we get that 2% positive inflation. But we have really low retail goods price increases. Number four, rising stock and home price. Like I said, if you're that 50% of Americans who own stocks, you're doing well. If you're the part of the 63% of Americans who own a home, you're also doing well. And that's typically a lot of our membership. So we got this positive wealth effect. Number four, the labor market's at full employment. I said that. We're at about 4% unemployment heading to 3.5. A lot of job openings out there. Low debt burdens, improving credit availability. You walk into a bank or credit union today, you're more likely to get approved for a loan than denied a loan. That's as opposed to about 10 years ago when a lot of people were being denied loans because of the bad Great Recession. And then the last one, of course, tax cuts. They love these tax cuts. You put these 7 or 8 factors together, that's why we're seeing lending booming the last few years. All right, maybe just kind of skip over this and get to the most important chart that we're covering today. Remember, we are credit unions. Right in the word, credit union, you got credit, loans, making credit. Look at the last 4 years. Credit union lending has been booming. 10, 11% growth. This is some of the best growth that we've seen in many years. What's the forecast? This year, 2018, just a slight slowdown, about 9% loan growth. Still strong, still above the long run average. Does anybody know what is the long run average for credit union loan growth? What's that 98.6 degree body temperature? About 7%. 7% is normal. That's what we've been, every year for the last 40 years, we typically grow loans about 7%. These last few years have been hot. Next year, 2019, we actually forecast we will kind of hit that 98.6 natural body temperature, about 7% loan growth, the long run trend. Then by 2020, we get a recession. Loan growth will slow down to about 5%. In recession, borrowing tapers down. So here's our forecast the next 3 years here, 9, 7, 5, a little bit of a headwind. So when we do our strategic plan, we do our forecast, do we just keep putting in 10%, 10%, 10% for loan growth? Well, it's going to be hard. We did that the last few years, but going forward, basically a lot of pent-up demand has been satisfied. People have bought their car and their appliances and the furniture. So we got a little bit of a headwind coming. Notice the natural cycle when it comes to big borrowing binge, and then the kaboom, big boom again, and then once again, the natural slowdown. Once again, by asset size, you can say, well, Steve, that's not our credit union. Well, if you look at billion-dollar credit unions, we're already seeing the slowdown between 2017 and 2018. Notice 12.7% growth in 2017. This year, 2018, slowing down to 11. So we're already seeing the headwind hitting credit unions. 500 million to 1 billion asset size, the slowdown. So we're kind of getting this headwind hitting us. What about the savings side? Are we getting the deposits in? Another big concern amongst credit unions is they're not seeing the deposit growth. We need these deposits to keep funding the loans. Well, notice this year, 2018, will be a weak year, only about a 6% growth in deposits. Why? Once again, this headwind. Nobody wants to save, everybody wants to spend because they have this high optimism. Notice by 2020, we should see about 9% growth in deposits. Notice, you can actually, as an economist, I can just look at this chart and tell you when the recessions took place. Here's a recession. Here's a recession. Here's a recession. Basically, the highest bars are recessions because people always save during recessions. They're worried about their job. They're worried about spending. So recession, recession, recession by 2020. That's when the money will pour in when we don't really need it because loan growth will be the weakest at around 5%. All right. Once again, by asset size, once again, 2017, 2018, billion-dollar credit unions are seeing a big drop. Medium size all the way down, seeing huge drops. I was just at a UW credit union. I was talking to our CFO and saying, hey, we're not hitting our target for our deposit growth. He said, yeah, we got this huge headwind nationwide. It's hitting all credit unions. I go, what are we going to do to hit our deposit targets? This is, we're raising rates. Money market rates, CD rates are going up faster than we forecasted, which means our cost of funds are going up faster than we forecasted, which means our net interest income will be lower this year because of that. So we got this headwind. If you want to hit your targets, rates are going to go up faster than we previously thought. All right, just kind of skip over this and get to the one of my favorite charts. Basically, is this credit union membership growth. Look at this. Last year, we had 4.4% growth in credit union memberships. And just look at the pattern the last few years. By 2011, it was 1.5% growth in membership. 2, 2.5, 3, 3.5, 4, 4.5. Almost like a nice step function up. Can anybody explain to me what's going on here? Population growth in this country is slightly less than 1%. But we're growing 4%. That must mean we're picking up market share from the banks. But what explains this huge growth of 4%? I like to call these the halcyon days for credit unions. Halcyon meaning prosperous and calm. What is going on here with 4% growth? What 3 words explain this?
Indirect auto lending.
Very good. Indirect auto lending. Basically, about a third of the increase here, the last couple of years, about 1.5 percentage points, is just due to large and medium-sized credit unions getting into indirect auto lending in a big way, stealing market share there. But of course, the big challenge with indirect auto lending is what? Turning those indirect auto members into a full PFI member, where we're the primary financial institution. What Meredith is talking about, how do you get those members to basically bring over all of their products, like their checking account, their mortgage, their credit card, all that stuff? That's very difficult to do. We kind of call it, it's the easy thing that's hard to do. convert an indirect auto lender into a PFI member. I actually asked our chief lending officer about 3 months ago, hey, what is our percent conversion rate of taking an indirect auto member and bringing them in and getting their checking account and their credit card? What do you think he told me? What percent of all indirect auto members actually become a real member of the credit union? He said 10%. And I said, wow, 10%, that's horrible. And he goes, no, actually, that's really good according to industry standards. Other credit unions only get like 2-3%. So it is really tough to do. Notice our forecast then for the next few years out. It drops to about 2.5%, mainly because all those indirect auto lenders will pay off their loan and leave. So we'll have a little bit of headwind here. But the point is, this is still good. If our population is only growing 1% and we're growing 2.5%, we're still picking up a nice share. Which brings me to this end. When is the next recession? I said 2020. And I've looked at every economic data series to try to figure out how to forecast recessions. And I've been doing this for about 30 years. And I found one data series that is the best economic series to forecast recessions. What is it? It's actually credit union data. If you use credit union data, you can predict recessions pretty well. What I do, I call this my growth rate gap. I just look at two growth rates from credit unions, and I subtract them, hence the word gap. I take loan growth at credit unions, which is what? I said we're growing about 10%, say, right now. Loan growth at 10%. Less deposit growth. Deposit growth right now is about 6%. Let's do the sophisticated math. What's 10 minus 6? 4. There it is. There's 4% right there. There's our number. Notice we're in a period where loan growth is very strong compared to deposit growth. Basically, people are borrowing future income for current consumption. Because what is credit? What is a loan? Basically, think of it like this. If I walk into UW Credit Union and say, I need a $40,000 car loan because I want to buy a new Cadillac, I'm basically tapping into my future stream of CUNA Mutual paychecks. Right? These are paychecks I haven't earned yet. They're coming in the future. I'm kind of grabbing this pool of money, this stream of paychecks, and I'm bringing them into the present and spending it. So not only am I spending my current paycheck, I'm spending future paychecks. That boosts the economy. That means a lot of current consumption, General Motors, current production, economy booms, just like it did back here. Notice in other times we have this period of a downside where savings is growing faster than loans. You have negative numbers here, and here people are saving current income for future consumption. This would be like, hey, I'm really worried about a recession coming. I'm going to save all my CUNA Mutual paychecks, put it in UW Credit Union, not spend anything. Well, if I'm not spending, by definition, that's a recession. This is bad times for the economy. All right, notice the relationship here between the pink bars, which are recessions. Notice when we go from loan growth being stronger than deposit growth, and right when we hit 0, then you get a recession. You go down here, people are saving a lot, rebuilding nest eggs, paying down debt. We come out of the recession, a lot of pent-up demand, people go out and buy cars, boom, you get a lot of spending. Then as soon as we hit 0, this is nice, this is called a leading economic indicator. This hit 0 about a year before the recession. So it hit 0, we could all predict the next recession, and boom, it popped up. We went into a saving mode, savings growing faster than loans. We came out of it, a lot of pent-up demand, we went crazy and bought those cars that we didn't buy for a while, bought a new refrigerator that we didn't buy for a while, and we had this huge boom there. And then it started to slow. But then something happened. We're starting to accelerate again. A little bit of acceleration, meaning loans growing a little bit faster or deposit growth being a little bit slower. What happened here? What explains why we're starting to accelerate again? No, well, let's use this drop right there. What happened in the fall of 2016? Yeah, some people call this the Trump bump. I don't want to get into politics here, but right after the election, things started to accelerate again. Why? Well, maybe because we had a unified government. We had Republicans controlling the executive branch, the Senate, the Congress. We know Republicans typically do tax cuts, deregulation, which typically helps the economy. Job growth accelerates a little bit. People get a little more confidence. We saw that in the chart. And we started to see a little bit more spending again, a little bit more borrowing. This acceleration right here in borrowing, after people kind of bought the car they really needed, here's kind of, you can justify this. People really needed to buy that car because they put up buying one for 7-8 years. But it started to accelerate again. There's an old saying in economics, which is kind of a humorous saying, about when people borrow for this type of spending, and it goes like this. People are spending money they don't have to buy things they don't need to make impressions that won't last on people they don't care about. Think of this as people going out and buying that Harley Davidson motorcycle that they don't really need. You really don't need a Harley Davidson motorcycle, but it's kind of fancy to have. A little bit of acceleration here. When is this going to hit zero? Remember, my model here just shows as soon as this gold area, whatever that is, a brown area, hits zero, that's the recession. So I forecast, I think the next couple of years will still be above zero. Loans will be growing faster than deposits. But by 2020, it'll reverse. And deposits will be growing faster than loans. When deposits grow faster than loans, that's where you get your pink bar, the recession. Notice the natural credit cycle here. If you remember in trigonometry, you ever have trigonometry in college? Remember I dealt with sine waves and cosine waves? I mean, this is a perfect model of a nice sine, cosine waves. Basically, what drives the U.S. business cycle? Now, if you take anything away from this presentation today, it's this. What drives the U.S. business cycle is the short-term credit cycle. Lending drives the U.S. economy. A lot of lending, things go well. When you have more deposit growth and less lending, you're in a recession. This drives the U.S. business cycle. Which brings me to my limerick of the day, just to kind of wrap up this whole idea of lending. And I say, credit unions have always depended on a rate of borrowing that is splendid, by consumers for whom their means to consume may soon find them overextended. Basically, they're taking a lot of loans now. They've been taking it on for quite a few years. After a while, they won't be able to keep on taking on these loans. In my handout here, you'd have my forecast for all these variables, economic, unemployment rate, things like that. Also for the credit union here for 2019. Nice summary of all the forecasts. I'm not going to go through all that. I just want to finish up with one last thought. People say, all right, Steve, you're forecasting a 2020 recession. How damaging will that be for credit unions? Well, we lived through the Great Recession. Only 100 credit unions failed in the Great Recession. 500 banks failed. That kind of shows you the power, the inherent strength of the credit unions. We are not-for-profit, member-owned cooperatives. We only lost 100 financial institutions with the credit union name on it. Banks lost 500. So I just want to say that credit unions are so robust that even if the big one ever went off, the only thing remaining will be cockroaches and credit unions, and of course, Keith Richards, because that guy is indestructible. And he basically lived his life with that old Latin phrase, carpe diem, seize the day. We as credit unions have seized these last 10 years, stepped in the void left by those 500 banks that failed, and basically have picked up market share, picked up members, picked up mortgage originations, and have done extremely well in the last 10 years, and I expect it to go for another 10 years into the future. All right, with that, any comments, questions, snide remarks before we break? Very good question about how fast the Federal Reserve raises interest rate. They're being extremely cautious this time because they've been blamed for causing recessions in the past by raising rates too fast and too far. Basically, they're going really slow, and in fact, a lot of economists believe they're raising rates too slow. That with the economy overheating, we should be at that maybe 3% already. So if anything, you could say the Federal Reserve has been too cautious in raising rates too slow. So we are concerned, Fed causing recessions by raising rates. We don't think they're going to do that this time, just how cautious they're really being. Because they've been criticized over the last 100 years. The Federal Reserve has been in place since 1913, and they have caused some recessions by raising the price of money too high. As I reiterate, the most important price in the economy, they're going actually probably too slow this time. Anything else? Yes, sir. Very good. Right now, the Federal Reserve is trying to shrink the size of the balance sheet, trying to roll off all these bonds that they have. So as they mature, they're not reinvesting it. And this year, they'll basically roll off $600 billion in bonds. Think about your own investment portfolio at your credit union. Let's having your investment portfolio shrink by $600 billion by not reinvesting the maturing bonds. Well, that's what the Federal Reserve is doing. But when you think about what the Fed is actually doing, is they're demanding $600 billion when they're not rolling over this. So they're taking out $600 billion from the economy. Once again, basic economics. You demand $600 billion, what's that going to do to the price of dollars? It's going to push it up. So that's another factor pushing interest rates up, is that the Fed is pulling money out. Same as the Treasury is pulling out $1.1 trillion. You got the Fed pulling out $600 billion. Add that together, it's what, $1.7 trillion Either the Treasury or the Fed is taking from the economy, which means interest rates have to go up then. If they're demanding that much money, the price of money has to go up by whatever, like I said, that 4% is our forecast.
So why hasn't the 10-year moved?
It actually has. The 10-year just a few months ago was about 2.9. Today it's about 3.08. So it's gone up 18 basis points in a relatively short period of time. You think, in a couple months to go from 2.9 to 3.8, that's a pretty, yeah, I know, I'm sorry. It's been low for a very long time, but it is starting to move. And like I said, the big thing is the European Central Bank. They're keeping it down because they keep printing up money. It's called their quantitative easing, print money to buy assets. But basically, once they stop, then you're going to see interest rates move up quickly to that 4%. But the European Central Bank is still printing right now. But I believe they're going to stop pretty soon. Anything else? Yes, sir.
The leverage in the system, it's all kinds of record high debt levels. Global debt is $200 trillion.
Very good. The whole idea of the debt, everybody's worried about when the next debt crisis coming. Corporate borrowing is kind of a little bit worse. When it comes to, corporate borrowing is getting a little bit high. The sovereign borrowing, government borrowing, as you saw, we're about, $21 trillion U.S. government debt. We pay about $240 billion of interest on that debt. And as our debt keeps rising each year, another $1 trillion roughly, and as interest rates go up on that debt, we're kind of here with the double whammy, right? You got more debt and higher interest rate on that debt. More of our government budget will be to finance just paying the interest on it, which means that's going to crowd out spending for other things like military, infrastructure spending, park rangers, FBI agents. So the big concern is right now we can afford this debt. But in the next few years we won't be able to if we keep running trillion-dollar deficits and the Federal Reserve is raising interest rates on that. So it will crowd out spending at our federal level. So we're going to have to make tough choices. Where do we want to spend our money? On infrastructure, military, or just interest on the debt? Anything else? All right. Well, thank you for your time.